Now, why are costs going up? Maybe they're mining some lower grades. Inflation is driving up costs. But gold is already up by about $300 an ounce this year. So gold is already up by more than double what they said their costs are going to go up. So that's still bullish. Yet analysts ignored the beat, right, and just focused on this negative comment that costs are going up, but completely ignoring that gold has already gone up more and will probably go up a lot more, right? Gold is not finished going up. Gold could be $3,500 by the end of the year. Maybe it'll be $4,000.
Gold prices reached a record high of $2,944 at Monday's opening bell and are currently trading around $2,940. The gold dollar index tracks the metal's performance and is up nearly 3 points in today's trading. The precious metal has maintained its strong bullish momentum in 2025, showing no signs of slowing down. It has gained nearly 12% year-to-date, achieving this remarkable feat in less than 2 months. Traders who entered the market last year are seeing significant profits this quarter. Financial advisor Peter Schiff attributes the recent sell-off in gold stocks to concerns over rising production costs, with Newmont predicting a $140 per ounce increase for 2024 and 2025. However, this concern may be overstated, as gold prices have already risen more than $300 an ounce this year, more than offsetting the higher costs. Despite this, analysts have focused on the rising expenses rather than the broader bullish outlook, which could see gold prices reaching $4,000 by the end of the year. Market attention is shifting to inflation, with the U.S. rate rising to 3% from 2.89% last month. Ongoing trade uncertainties, including new tariffs and retaliatory measures, create volatility and make investors cautious. As a result, institutional funds are seeking safe haven assets like gold, driving its prices higher. The mining sector, particularly gold mining, is gaining attention amid the ongoing gold rally. Newmont Corporation, the largest gold producer, reported a 115% increase in free cash flow, surpassing expectations. However, mining valuations remain low, with the Van Eck Gold Miners ETF still well below its 2011 highs despite a $1,000 rise in gold prices. Investor sentiment is lagging, making it difficult for miners to raise capital. Schiff also points out algorithmic trading has contributed to recent sell-offs, driving stock prices down despite strong earnings reports. This disconnect points to overlooked opportunities in the mining sector as gold prices continue to climb. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold stocks got hammered even more than the overall stock market when the price of gold was not down very much. Now it's down about $6 or $7 today, but it's still, tonight, I'm in the evening, but it's still $29.30. The record high is $29.42, $29.43. So we're almost at record highs in the price of gold. So why did these gold stocks get clobbered? Well, I think it was more of a buy the rumor, sell the fact on the phenomenal earnings that gold stocks were reporting on Thursday and Friday. And they bought the rumor, sold the fact, except nobody really bought the rumor. They just sold the fact. Nobody was buying gold stocks because of all these great earnings, at least not that many people. But they sure, programmed the computers to dump them as soon as the earnings came out, especially if the earnings missed. So take a company like IAM Gold, which I own IAM Gold. We own that in our funds. That stock was down 9.4% yesterday. That's a big drop for IAM Gold, right? And they missed their earnings, but their earnings were up 717% from the prior year. That is an enormous increase in earnings. Revenue was $1.63 billion. That was a 65% increase over the revenue from a prior year. So a massive increase in earnings. And their earnings in 2025 are going to be even greater than they were because a lot of the gain in the price of gold happened at the tail end of last year. And we've had a big move up already in the first couple of months of this year, right? So earnings are going to be up, but the stock got killed. But it's trading at 10 times earnings. If you're only at 10 times earnings and you just grew your earnings by 717%, why would your stock go down because you didn't grow your earnings by 750% or whatever it was the analysts had expected? It's almost like they deliberately have a high expectation so the stock can't meet it, so it gets clobbered, even though the earnings growth is phenomenal. Now, right, Newmont Mining reported, I think blowout earnings. The stock was down almost 6%. Almost 6% on Friday. And it's these type of stocks, right, that are really driving the narrative. But so Newmont was supposed to earn $1.09 for the quarter. They earned $1.40. So 31-cent beat. That's a big beat. Also, their earnings for the quarter, the rise from the prior quarter was 285% increase in profits, and revenue is $5.6 billion. But almost a tripling in quarterly profits. And the estimates, they beat their estimates by a full 9 percentage points. But the stock went down. And the bad news, right, what really got people to sell the stock was that they forecast their all-in production costs would be higher in 2025 than they thought. I think it was around $140 an ounce extra. Now, why are costs going up? Maybe they're mining some lower grades. Inflation is driving up costs. But gold is already up by about $300 an ounce this year. So gold is already up by more than double what they said their costs are going to go up. So that's still bullish. Yet analysts ignored the beat, right, and just focused on this negative comment that costs are going up, but completely ignoring that gold has already gone up more and will probably go up a lot more, right? Gold is not finished going up. Gold could be $3,500 by the end of the year. Maybe it'll be $4,000.
Peter Schiff believes the latest economic data released on Friday has further reinforced concerns about stagflation, suggesting that the U.S. is moving toward a challenging economic environment. If inflation continues to rise while economic growth slows, the Federal Reserve may find itself in a situation where no policy adjustment can effectively tackle both challenges simultaneously, increasing market uncertainty. Investors and economists anticipate that the U.S. central bank will respond strongly and systematically to inflation and the labor market shifts. Research published on Monday by the San Francisco Fed highlights the heightened sensitivity of financial markets to U.S. economic data, with the Fed's perceived responsiveness increasing notably in recent years. 2022 inflation data became the primary driver of policy expectations, while labor market conditions took precedence in 2023. This pattern aligns with the Fed's response to inflation, which began rising in 2021 but did not prompt rate hikes until 2022. Similarly, when labor market data weakened in mid-2023, it played a key role in the Fed's decision to lower the policy rate by a percentage point starting last September. The Fed's target policy rate currently stands in the 4.25% to 4.50% range. Recent economic indicators, including a survey released on Friday showing business activity declining to a 17-month low, have strengthened market expectations for 2 quarter-point rate cuts this year. Let's get back to the interview.
The gold stocks got clobbered very hard, unnecessarily so, which is, again, typical the case for the gold stocks. The GDX was down about 3.4% on the day and about a similar amount on the week. And the GDXJ was down 4% on the day, which, again, was about the weekly decline. But gold was barely down, maybe $2 or $3 on Friday, and it was up about 1/3% on the week. So, again, gold went up and gold stocks went down. Now, gold stocks are still up about 15% on the year, so they're still beating gold, which is up about 10.5% on the year. But they should be up a lot more when gold has been this strong. And I'm going to get to the gold stocks a little bit later as far as, why they went down. But I want to talk more about why the overall market went down. What was the news that drove the stock market down on Friday? And I think it's more confirmation of stagflation, which is exactly what I have been predicting all along. And of course, stagflation is the one economic condition for which the Fed has no contingency plan. When Powell was asked what his plan was for stagflation, he knocked wood. He banged on the podium and he said, well, we're just going to hope we don't have it, right? Well, hope is not a plan, right? But the reason the Fed doesn't have a plan is because there's nothing in their toolbox that will work, right? The Fed doesn't have a lot of tools, right? It can cut interest rates, it can raise interest rates, it can expand the money supply, or it can contract it. That's basically it. Although it never really contracts it much, but it can do QE, it can do QT, whatever, but that doesn't have a lot. But when the economy is weak, that's when it cuts rates and supposedly prints money. When the economy is strong, it raises rates. Well, what do you do if the economy is weak and inflation is strong at the same time? The Fed's got nothing. That's why they just hope it doesn't happen. And that's also why the stress tests that the Federal Reserve develops for the banks does not include a scenario of stagflation. because I think the Fed knows that none of the banks could pass a stress test if they had to test for stagflation, which would be a weak economy where inflation and interest rates go up. Because the worst case scenario that the Fed has asked the banks to stress test is a weak economy where interest rates plunge and inflation goes way down, right? Which is not that bad. What is bad is a weak economy where interest rates and inflation go way up. But the Fed did not ask any bank to run the numbers on that scenario because I think they know that all the banks would fail. But that's exactly where we are headed. And that is what the economic data that came out on Friday confirms.
Gold's impressive rally continues to defy market skepticism, with prices soaring and institutional demand surging. Yet mining stocks remain undervalued, and investor sentiment hasn't caught up with the metal's gains. As inflation concerns and economic uncertainty grow, will gold's momentum push it past the $4,000 mark, or will external pressures create hurdles for further growth? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.